One of the most common questions I get asked is, what is a safe withdrawal rate for retirement? Finding that answer is key to getting the most income in retirement, which is why Morningstar every single year does a research study and looks at what is the new retirement spending withdrawal amount you can expect for the upcoming year. Often the cited number is 4 percentage points. Are you able to maybe take out more than 4%, or would you need to take out less than 4%? I'm going to break down Morningstar's recent study and share with you the two things that Morningstar said you can use to boost your income in retirement beyond that 4% safe withdrawal rate number. Now, of course, before we talk through the safe withdrawal rate number, understand really what this is talking about. This is not safe, guaranteed, oh my goodness, you'll never run out of money. What they're looking at is a 30-year time frame, and what is the worst case scenario during a 30-year time frame, and then what was the amount of starting, what could you start with in a percentage manner for the rest of that 30 years. You might have a retirement that's longer than 30 years. You might have other things going on like a Social Security or a pension, but that is the base case. It's good to understand what is that base case when you're looking at this. Of course, the big headlines is, oh my goodness, the rates are lower. There is less that you can take out of your retirement now for 2025 compared to the prior year of 24. I'd say that's more of like a clickbait headline. Because if you think of January 1 of 2024, where Morningstar said that their number is 4 percentage points as opposed to the new number of 3.7%. If you think back to January 1 of 2024 and you had $1 million at that exact time frame, 1 million times 4% is $40,000. Well, the stock market went up in 2024. So is this new lower 3.7% amount actually falling backwards? I don't think so. I took a look at the Vanguard Balanced Index Fund, not saying you should buy Vanguard or this is the fund for you, but I was just curious. What does an index of balanced mutual fund investments look like for 2024? That looks to be up about 15%. If you started at $1 million in January of 2024 and could only take out 4% if you're following Morningstar study, that's $40,000. Well, if you had grown instead, perhaps you didn't retire, but you had grown instead to 1,150,000 and took out only 3.7%, that number comes to $42,500 that you could take out then. That's an increase of over 5%. So looking at, oh my goodness, the rates are down. I can take out not even 4 percentage points from my retirement. Think of your starting situation, where you likely have a higher balance at the beginning of 2025 compared to the beginning of 2024, despite the lower number. Kudos, though, for Morningstar for recognizing that perhaps when valuations are higher or lower, that they make recommendations that your starting percentage of how much you take out of your retirement should be perhaps changed as well. One way that Morningstar suggests you can boost up and take more income at the start is to be more flexible with how you take money out. They look at and say, what if you decide not following the exact 4% rule of every single year I give myself an inflation raise? What if when the market drops, I skip that inflation raise? Something that seems quite logical, where if the market is down, if you have less money, why take out more out of your investments when the market is down? If that's your plan, that you will skip the inflation raises, the extra pay raises that you might give yourself when the market had dropped, you can start with a higher rate of 4.2%. Or what if you follow a different method called Guardrails, where you give yourself pay raises based on when the market goes up, or perhaps you give yourself a little bit of a pay cut when the market goes down, not just specifically the inflation amount where it only gives yourself inflation raise when the market goes down, but maybe you're giving yourself a pay raise when your investments grow big enough. You could start then at a higher rate of 5.1%. So being more flexible is a way that Morningstar points out you could start with a higher amount. Now, another way to boost your overall spending is to look at this idea of, do you add some sort of guaranteed income to your retirement? Well, most everyone's got guaranteed income already with Social Security. Morningstar took an assumption that you would take Social Security at the new full retirement age of 67. They also looked at what if you took Social Security earlier and what if you took Social Security later. If you happen to take Social Security earlier, there is a drop in your lifetime spending of almost 15 percentage points overall. If you waited on Social Security all the way to 70 and gave yourself something called a bridge, where you pulled some money out of the market, set it aside more towards safer type investments, and relied on that money while you waited on Social Security, that gave yourself a boost of roughly 15%. Another way you could even give yourself a little bit more of a boost is through the idea of guardrails or using Treasury inflation protected securities to boost your income. They took a look at immediate annuities and whether that would boost your income, or deferred annuities, which means you wait until later to turn on that income. And overall, what they found is that the combination of waiting on Social Security and following the flexible type of spending patterns and perhaps adding some sort of other guaranteed income really boosted your overall spending above that base case of what they call the safe withdrawal rate at 3.7%, otherwise known as the 4% rule. Although what Morningstar is doing is saying the 4% rule might change. It just shows how important it is when you are planning for your retirement, not to rely on just one specific factor. What you ought to look at is, how does everything pull together? How does my investments and how much I take out of that pull together with my Social Security? And do I add in anything else with something that might be a guaranteed income? Take a look at the entire picture, which is why I've put together the 5-step retirement income plan. Head to 5stepretirementincomplan.com to learn more about how to take in order the steps you need to take for your retirement planning. Hi, I'm Jeremy Keil, owner of Keil Financial Partners. And if you're interested in seeing how we help our clients get more income, pay less in taxes, and avoid big retirement mistakes, make sure to go to keilfp.com. That's KEILFP.com.